Welcome to the deep dive. Today we're getting into term finance. They're a platform doing some interesting things in DeFi, decentralized finance, mainly by focusing on fixed-rate borrowing and lending, which is actually kind of novel there.
It really is. Yeah, we've been digging into a recent interview with Dion and Billy Welch from Term Finance. It was on Leviathan News, and it gave us a lot of insight into how they're approaching things.
Right. So our mission today, pretty straightforward. Figure out what makes term finance tick. Especially this focus on fixed rates when so much of DeFi is variable. We'll also look at their token launch, which pick a bit of a different route.
Yeah, definitely buck the trend there.
So if you're out there trying to make sense of DeFi volatility, maybe looking for steadier yields or just managing risk better, this should be right up your alley. Okay, let's unpack it. Where did term finance even start?
Well, initially, their focus was very much on the, let's say, more sophisticated end of the market. Professional traders, the really big yield farmers.
Ah, okay.
Yeah.
Not the casual user then.
Not at first, no. Their main product was these term auctions. That was the core offering.
Term auctions.
Yeah.
Okay. And were these just a small thing, or did they get traction?
Oh, they got traction. We're talking nearly $300 million in fixed-rate loans cleared through those options.
Wow. Okay. So nearly 300 million. That definitely proves there was a demand for fixed rates among those power users.
Absolutely. It really validated that need. But what's interesting is that they didn't just stop there. They wanted to make fixed rates accessible beyond that core group.
Right. Because auctions, I imagine, require you to be pretty active, timing things right.
Yeah.
It's not exactly set and forget for someone just getting their toes in.
Exactly. It wasn't really plug and play for, the average person maybe exploring DeFi in their spare time. So they started expanding new chains like Avalanche, more planned, and crucially, building products for, well, more passive users.
Okay, so moving beyond the expert crowd, what kind of products are we talking about?
Well, the first one they mentioned is called Blue Sheets Earn.
Blue Sheets Earn. Catchy name. What does it do?
Think of it like this. People who got loans in those auctions, they can now list those loans for sale at a fixed rate, of course.
Ah, I see. So it creates a kind of secondary market.
Precisely. It adds flexibility. Someone who locked in a loan can offer it up whenever, and a lender can come in whenever they want outside the strict auction schedule.
Okay, so it decouples lending from the auction timing. Makes sense. And how's that been doing?
Pretty well, it sounds like. They mentioned volume around $10 to $15 million. So definitely filling a niche for that sort of on-demand fixed-rate lending.
10 to 15 million, not bad. But even with that, you'd still need to manage things, right? Like redeeming loans, reinvesting.
Yeah, still some active management needed. And recognizing that, they developed their next product, Vaults.
Vaults. Okay, that sounds potentially more automated. Tell me about those.
So these are built using Uniswap v3 infrastructure, which is, pretty well regarded in DeFi for security and efficiency.
Right, UniV3 is solid.
And the key thing here is curation. They have experienced firms, they mentioned M Capital and R7, actually managing these vaults.
So wait, it's like having a professional manager handle a portfolio of these fixed-rate loans for you.
That's exactly the idea. You deposit your funds right now. It's mainly USDC, but they said ETH vaults are coming soon, and these curators handle putting it into the loans.
And what happens if there aren't loans available right away?
Good question. Any capital that's idle, not deployed in a loan, is kept in secure, low-risk environments. The whole process aims to be automated for the depositor.
Okay, that really does sound like a big step towards making fixed-rate yields more accessible. You deposit, they handle the rest. And they mentioned traction there too.
Yeah, over $10 million in one vault already, the Meta Vault, with ETH vaults coming up. So it seems to be resonating with people looking for those stable returns without the headache of constant management.
Definitely simplifies things. Okay, let's zoom out a bit. Why is this focus on fixed rates so notable? I mean, most big DeFi lending platforms like a YAV are all about variable rates.
That's the key distinction, predictability. With variable rates, especially when the market gets hot, borrowing costs can just skyrocket. You hear stories of rates hitting 60%, maybe even higher.
Oof. Yeah, that's pretty wild.
Fixed rates just eliminate that drama. Borrowers know exactly what they'll pay. Lenders know exactly what they'll earn for the whole term of the loan. Certainty.
That certainty must be hugely appealing in such a, volatile space. But hasn't the big challenge always been liquidity? Like, what if you need your money back early from a fixed rate position? It's not like pulling from a big variable pool.
That's the historical problem, yes, and that's really what term finance seems to be tackling head on with things like blue sheets and the vaults, building those mechanisms to create liquidity for fixed rate positions.
Right, building the infrastructure for it.
Yeah.
Okay, you also mentioned capital efficiency. How does term compare there?
Well, their typical loans are pretty short term, think 4 weeks usually. But the crucial point they made is that term finance doesn't maintain massive reserves of idle capital.
Unlike some of the big variable platforms, they mentioned AAV having what, like 50% of its USDC supply just sitting there at one point?
Exactly, and that huge pool of unproductive capital tends to push down the yields for lenders. So the example was maybe AAV lenders get 2.5% while borrowers pay 5%.
Right.
Term, because it doesn't have that drag from idle funds, can often clear its auctions between those rates. So potentially, borrowers pay less than 5%, lenders earn more than 2.5%. It's more efficient.
Ah, I see. Less idle capital means better rates for both sides, potentially. That makes a lot of sense. Did they talk about longer loan terms?
Yeah, they mentioned there is demand for longer terms quarterly, semi-annually, even yearly, mostly from institutional players dealing with larger sums. It sounds like that's on their roadmap too.
And I guess that fixed rate becomes even more valuable for longer terms, especially for certain strategies.
Definitely. Think about stablecoin farmers using ETH or BTC as collateral. Those assets can swing in value. Locking in your borrowing cost with a fixed rate, that's huge for managing risk. Protects your yield if rates suddenly spike.
Yeah, that predictability against volatile collateral is a powerful combo. Okay, let's switch gears. The token launch. This really caught my eye because they went CEX first, centralized exchanges.
They did Kraken and MEXC to start, which, goes against the grain a bit lately, where everyone seems to favor launching on decentralized exchanges first.
Exactly. And there's been a lot of chatter, some criticism about CEX listing practices exchanges demanding huge token allocations, maybe dodgy market maker deals. How did Term navigate that?
They seemed very aware of those pitfalls. They specifically called out concerns about, giving exchanges massive chunks of tokens, which can just lead to dumping and hurt the community.
Right.
And they also mentioned being wary of market maker contracts that involve things like unlocked token loans or call options, feeling those aren't always aligned with the project's long-term health.
So they went in with eyes open. What were their actual deals like with Kraken and MEXC?
Well, with Kraken, they said quite notably there were no listing fees involved at all.
Really? No fee. That's rare.
Seems so. And with MEXC, it was different. MEXC was apparently an early investor, so they got a relatively small allocation, like 120,000 tokens, specifically for a community staking pool. And MEXC matched that with USDC rewards, so it was framed more like a partnership to benefit users.
Okay, so not the typical huge fee. So why start with CEX liquidity then, if DX launches are the trend?
Their argument was basically capital efficiency for initial liquidity. They felt a well-managed CEX listing, maybe with a good market maker, could provide deeper, more immediate liquidity and potentially less slippage for users right off the bat compared to spreading capital thinly across, say, an older Curve V2 type pool.
Okay, so aiming for better immediate trading experience.
Yeah.
But they aren't skipping DXs entirely.
No. They explicitly said a DX pool is coming soon, mentioning Uniswap V3 as a more efficient option for that.
Gotcha. And transparency on tokens. Where are they held?
Yeah, they emphasize that. DAO and foundation tokens are in publicly viewable on-chain safes. And insider vesting, handled by a platform called Magna, with really long schedules, a 1-year cliff, then 4 years linear vesting after that.
Wow, a year cliff and 4 years linear?
Oh.
That's a serious lockup.
It is. They even said they turned away potential investors who weren't okay with those long-term commitments.
That says a lot about their focus.
It really does. Their philosophy seems to be build a product that works, get product market fit, then the token acts as, they called it a juicer. It enhances what's already there. It's not the main attraction.
Like Curve, maybe. The platform's utility drives things.
That was the comparison they drew. And yeah, they also gave a pretty clear warning to listeners to be careful about some CEX launch practices that can be, well, predatory.
Good advice. It's a refreshing take, focusing on substance over hype. Okay, slightly different topic, but related Circle's IPO.
Ah, yes, the USDC issuer.
Yeah.
Trying to go public again. Current valuation estimate around $5 billion.
That's a big deal for stablecoins. What were the takeaways from the interview on that?
A major point was just how significant Coinbase's role is in the whole USDC ecosystem. Distribution, revenue sharing.
Yeah.
It's massive.
The power of that CEX integration. We see it with Tether, too.
Absolutely. And it led to an interesting point for potential investors. If Coinbase gets such a big slice of the USDC pie, maybe investing directly in Coinbase stock is actually a better way to get exposure.
Huh. That's a provocative thought. Did they speculate on Circle's future business model?
Yeah, they mused that maybe Circle needs to move beyond just earning interest on reserves, perhaps more towards tech and services.
And the whole stablecoin world could be changing, right? With potential regulation like a stablecoin bill.
Definitely. Could open the floodgates. The interview mentioned Agora, but also big TradFi names like JP Morgan, maybe retailers like Walmart, even Facebook potentially trying again.
Wow. So we could end up with lots of different stablecoins competing.
Could be. They floated the idea of a fragmented market, maybe like U.S. banking back in the 1800s, which for DeFi protocols like term finance means figuring out how to aggregate liquidity across all these different stables. An interesting challenge.
For sure. Okay, wrapping up, what's next for term finance itself? What future plans did they mention?
Some pretty ambitious ones. They talked about potentially offering much longer term fixed rate loans.
Longer than 4 weeks?
Much longer. They even threw out the idea of like 30-year terms.
30 years on crypto assets?
Yeah, specifically on liquid ones like ETH and BTC. Their point was these are fundamentally more liquid than, say, a house, so maybe long-term fixed rates make sense.
That's a fascinating idea. 30-year fixed on Bitcoin. Wow. Anything else?
Yes, the token staking mechanism is coming.
Ah, staking term tokens. How will that work?
It's based on a contract called the Unistaker.
Yeah.
The gist is you stake your term, you have to delegate your voting power, could be to yourself or someone else, and then long-term stakers will get a share of the protocol fees for participating in governance.
Okay, standard model. Fees for governance participation.
But they were clear they're being strategic about when to turn on the fee sharing. They want the protocol to hit state velocity first, basically, achieve significant adoption and sustainable growth before heavily incentivizing staking with fees.
That sounds sensible. Mature, even. Build the user base first, then reward the participants. Okay, let's try and summarize this deep dive on term finance.
Okay, so term finance is really carving out a niche in DeFi with fixed-rate products. They started with the pros via auctions, but now they're expanding to more passive users with things like Blue Sheets Earn and these automated vaults.
Right, making fixed rates more accessible.
Exactly. And their token launch was quite deliberate. CEX first for initial liquidity, long vesting, focus on product market fit over hype.
A contrarian but seemingly thoughtful approach.
And looking ahead, the whole stablecoin landscape is shifting, which impacts everyone. Plus, Term has these ambitions for potentially very long-term fixed rates on major crypto assets. Lots of interesting stuff happening.
Definitely. So here's a final thought for you, the listener, to chew on. How could bringing concepts like fixed interest rates, common in traditional finance, into the transparent, accessible world of DeFi change how you think about earning yield or managing risk?
Yeah, and also, as we potentially head towards the world with many different stablecoins, what does that mean for you as a user and for protocols like term finance trying to navigate that complexity?
Lots to consider there. We hope this deep dive gave you some valuable perspectives on term finance and the evolving DeFi landscape. Thanks for tuning in.